Hello, everyone, and welcome to this edition of 401k and Beyond. We've got Will Rhind today. Will Rhind is joining us from GraniteShares. So GraniteShares is an ETF provider. They've been in the game for about 5 years now?
Yeah, just about 5 years.
All right, 5 years, 5 ETFs. So you're kind of an industry vet. So let's talk a little bit about your background first and how you came to start GraniteShares.
Yeah, sure. Well, first of all, thanks for having me on.
Absolutely.
Much appreciated.
Sure.
So my background, I'm from Scotland originally. And I suppose I started my kind of financial career just out of college in London. So I was working for an investment bank just out of college. And then after about 1.5 years of doing that, I transitioned into the asset management world and joined a company at the time called Barclays Global Investors. And Barclays Global Investors at the time was bringing out the first exchange traded funds, or ETFs, as everybody knows them now. And so we were listing the first ETF products in Europe. Now, obviously, that business became better known as iShares, and was then acquired by BlackRock during the financial crisis. But my story is really that I sort of stumbled my way across these newfound products called ETFs, back in the early 2000s, and then really have stayed with that product throughout my career. So after BlackRock or iShares, I built and managed businesses within the space, sort of really ending with starting my own business, GraniteShares, in 2017. So we actually technically founded the company summer of 2016, but building an asset manager, takes some time. It's not just like something you can do overnight. So it took us about a year to build the asset management infrastructure, to get the licenses, et cetera, in place. And then we went live summer of 2017, and we're going, or still going, I should say, 5 years later.
That's pretty good. So how did you end up in commodities? At the focus of that you came up with that before the name Granite. So how'd you end up in?
Well, the commodity angle is that after iShares, I joined a startup ETF company in Europe that were actually listing the first commodity ETFs in Europe. So that's how I got to really start my career on the commodity side. And so we're doing the first gold, and then securitizing other forms of, or other commodities into exchange traded products. And that was a very big success. And it was in the 2000s, leading up to the financial crisis, and ultimately at the top of the commodity market in around 2011. After that, I actually became the CEO of the Gld Etf, which is the Spider Gold Trust. That's actually the largest commodity fund in the world. And so was the CEO there for 2.5 years before leaving to set up GraniteShares. So I've been involved now on the commodity side for quite some time. And I think, put simply, Brian, when we started GraniteShares, I believe that we were, at the closer to the bottom than the top, put it that way, of the commodity market back in sort of summer of 2017. I believe that it was an asset class that had been out of favor for some time, typically since the top in 2011. So that meant on the product side, or the asset management side, there was a huge amount of innovation that was just frankly lacking in the space. In other words, people were prioritizing the latest hot equity or bond product. Nobody looked at commodities. And I felt like that was a good place for us to start with the business. And very simply, we were able to create the best product in the market at the lowest cost, innovate on both the structure of the ETF itself, so providing exposure to commodities with no K1, but also give people the lowest cost exposure. And that was kind of a unique opportunity that we couldn't do, say, in the equity side or on the bond side, because it was so heavily competed. So that was really allowed us to bring those kind of innovations and got our start in the commodities. So I think it was a combination of time being right, it felt like, for commodities, plus we had an opportunity to innovate in that space in a way that we didn't in other asset classes.
Okay. Yeah, that's a good background. For our group here, we've got some very novice investors. We've got some people, 25 years old, $20 paycheck. So all the way up to the more advanced people. So for your basic investors, why is it important to have some commodities in your portfolio, or maybe it isn't. Maybe you just start with your regular stock bond ratio and add commodities later. What are your thoughts overall on portfolio position in commodities?
Well, let's start maybe by saying, why would you own commodities in the first place? And the two most common reasons to own commodities that are always cited are as follows. Number one, to protect your portfolio against inflation, and or number two, which is for diversification purposes. In other words, you have stocks and bonds in the portfolio already, and you're adding another asset class that moves or performs, behaves differently to those stocks and bonds, so that in times where your stocks sell off, for example, or the market falls, you have something else that may move in the opposite direction, and that could be commodities. So that's a good kind of place to start. And I think if you're talking about very novice investors, in perhaps you could say ordinary times, what's the first thing you do in the market? I'm not sure that commodities would be the first thing on your list in terms of getting into the market. Buying an S&P 500 or buying broad market exposure is probably the best thing for the majority of investors to do. I think what changes, Brian, though, is the environment that we're in right now, which is we're seeing the highest inflation in the economy since the 1970s. And the traditional techniques, I guess, that people have become accustomed to, arguably are no longer working or are not suitable really for this environment. So the 60-40 portfolio you briefly mentioned, this will be the first time in several years that the 60-40 portfolio has lost money year to date. And so the stock market's down, the bond market is under pressure with rising interest rates. And so there's a cocktail of problems for that sort of traditional, let's call it 60-40, generic portfolio. So what has worked this year? Well, it's commodities put quite simply, but practically every single commodity, doesn't really matter which one you're talking about, from gold to agricultural commodities. So in that context, I would think about having commodities at the moment as a way to hedge against inflation, particularly as we're seeing record high gas prices, energy prices, material prices. And obviously we can't talk about commodities without at some point talking about the war in Europe at the moment and what that's doing just to exacerbate the situation and move commodity prices even higher. Sure.
And how about that? How about that war? How has that affected your trading and your day-to-day operations?
Well, for us, it has a very limited effect in terms of the ability for us, I guess, to run the business. Where it does have an effect is where you see extreme or outsized movements in any of the commodities. And so when you have what's called a limit up or a limit down move in a given commodity market, then that means that the market is suspended on that day because of extreme price moves. And so that affects our ability to buy that particular commodity or sell that particular commodity. This is all quite common, by the way. There's nothing out of the ordinary. But it really has limited effect other than it's the price moves that we see. It's the sort of the frenzied activity in the market that's leading people to come in and buy and obviously gain more exposure to commodities at this particular time.
How is it helpful to be invested in the commodities themselves rather than, let's say, for example, in the gold field, investing in the miners? Why is it important to have the actual gold?
Well, the first thing is the biggest misconception I think that people have when they look at this particular question is the majority of people want to make money because the commodity price is going up. In other words, they think, oh, if the price of gold goes up 10%, I want to make 10%. And you can only do that, just to be very clear, if you invest in gold, i.e. if you invest in the commodity itself, because that's what you are buying, that's what you're getting direct exposure to. The problem comes in when people then buy a gold mining company, the price of gold rises 10%, and they end up with something which is not 10%. It may be more, it may be less, but it almost certainly is not 10%. And the reason for that there's many reasons for it, but number one, companies are typically operating, with a diverse book of business. In other words, gold may not be the primary thing that they're doing. They have other income streams available. They have debt, which they take on board, so they're managing debt. They have management teams which are also managing projects, and there's risks involved in that. But the number one reason, particularly relevant for this conversation at this time, Brian, is that the reason why gold miners in particular, but other commodity producers underperformed the last time that the cycle was sort of nearing its peak in the sort of mid 2000s and the run up to 2011 was that energy prices were rising higher at the same time. So in other words, the inflationary effects that we're seeing through higher energy prices were being reflected in those commodity companies, because commodity, gold mining in general is a very intensive, energy intensive activity. And put simply, they just couldn't pass on those inflationary costs, absorb those inflationary costs in a way that benefited the stock price. So they underperformed the market because of it. And the same thing is going to happen this time around if they're unable to pass on those inflationary costs to consumers. And that's, of course, the number one reason why stocks do badly in an environment with a higher inflationary environment, because typically majority of companies get to a point where they just can't pass on that inflation to their consumers.
The ETF format, why does that work so well for commodities versus starting a mutual fund? Why did you go that route?
Well, I think that it's not necessarily that there are benefits to commodities in an ETF per se. I think it's just benefits to the ETF wrapper or the ETF fund structure over mutual funds, and that's why overwhelmingly the skew of assets now in America invested in funds is going ETF versus mutual fund. And typically those reasons are mutual funds tend to be more expensive from a fee perspective, a management fee perspective. They don't offer daily liquidity or intraday liquidity, I should say. In other words, ETFs are listed on the stock exchange and you can buy and sell the shares whenever you want, as opposed to mutual funds, which are typically once a day. But probably the big reason that most people don't talk about is that ETFs are more tax efficient. And what I mean by that is when you're in a mutual fund, if other investors sell, then that's a taxable event for the shareholders who remain in the fund. The great thing about the ETF structure is that when people sell, they do that outside of the fund, and therefore it doesn't create a taxable event inside the ETF. And that's why typically you see ETFs very, very, very rarely have capital gains at the end of the year or taxable events that are passed on to shareholders. So it's just a great wrapper for investors more broadly. You can get exposure to almost anything you want. Mutual funds tend to be a lot more limited in terms of what exposures, what things you can invest in. And ultimately, people like that flexibility and low cost.
Okay, let's talk a little bit about your product lineup here. We pulled it up on the screen. So the one that they're all kind of interesting in their own separate way here, but you look at BAR. Obviously, you came from the GLD world. So what made you've got a massive fund at that time? I don't know what the assets were when you left GLD, but what made you think you could do that a little bit better? And what's better about your fund than GLD?
Well, I think that, like probably a lot of entrepreneurs or people that start their own business, one of the most common things for people to do is you gain industry expertise or an expertise in a particular industry, and then realize, hey, I can do this better. I can do this cheaper. I can do this faster. And the customers will benefit from doing that. And I think that was just a very simple thing that allowed me to start GraniteShares. And GLD, and there's plenty of other funds like it in the market, that they are very well known. They have a very strong brand and a lot of assets. And because of that, they have no incentive to lower their price or to be more competitive for customers, because people will pay the price that they're advertising for it. And so that doesn't mean to say that there's no room for a competitor or there's no room for a better product. It's just that the incumbent, the branded entity, isn't going to adjust, isn't going to change their ways. So that creates an opportunity for somebody to come in and offer a more competitive product. Now, the thing about gold, which is kind of interesting, is that at the end of the day, it's just bars of gold in a vault. And so you're offering almost the exact same thing, but for a fraction of the cost. In our case, some 60% less expensive. So it really is just as simple as that. It's a way to do the same thing that the big fund is doing, but a lot less a cost, and make it more efficient for customers. And ultimately, it's the investor who wins by owning an asset like gold that doesn't pay a dividend or doesn't have any income coming off it, that you want to own that as for as cheap as possible in your portfolio, so that you have minimal friction. And that's what bar does.
What are the mechanics behind that? Because I find that fascinating. I mean, most people think of, if your regular mutual fund or ETF, shares or certificates in a particular stock, but you actually have the bars somewhere. They're at a location, and if I remember correctly, somewhere near an airport or something like that. It's almost like something out of a movie. How's that actually structured?
Yeah, exactly. So obviously we can't reveal the location because that's top secret. But in many ways, look, it's the same as what used to happen with stocks and with funds, and that once upon a time there were physical stock certificates that backed up stocks that were held in a maximum security vault at a bank. And gold obviously is no different, but the processes and the traditions around gold have continued to this day. And so there's a maximum security vault. In our case, we have the vault in London, and that's the reason it's London is because that's the global headquarters of the physical gold market. And think of it as like a warehouse type analogy, whereby if you take material or any kind of physical thing to a warehouse for storage, you're going to get a receipt in return. And that receipt, think of it as like the shares that you get for the Gld Etf. And then when you come to get rid of it, you can sell those back kind of in the market. So we have a maximum security vault. When people are buying gold, we take gold into that vault and issue shares as so-called receipts, for the claim on that gold. And then when we're taking gold out, we're canceling those shares and taking gold out in the market, out of the vault, and selling in the market. So the important thing is that this physical gold, it's 400-ounce bars actually that back every single ounce of gold in that particular fund. And those are all held in a maximum security facility in London.
You're not trading in futures contracts or having to deal with any sort of roll yield or contagion or anything like that. This is actually the physical bars. Are all of your funds invested in the physical securities?
So just the precious metals. So when it comes to commodities, the basic rule of thumb is if it can decay or die, it can't be held physically. So that's why outside of precious metals, with a natural environment, is going to be a maximum security vault. You're going to have to hold a futures contract for something like wheat, any of the agricultural products, livestock, and obviously to that end we hold futures contracts obviously on the metals as well, where holding ounces of gold is very efficient because the price of gold is so expensive, so you don't need that much storage space to store a high value of gold. But if you then translate that to something like copper or something like tin, nickel, zinc, etc., you're starting to talk about huge amount of space if you were to hold that physically, and to a point where you can't store it in one location. And so typically the way to get that exposure is via the futures market. But in terms of our products, BAR, which is the Gld Etf, that's physically backed. PLTM or Platinum, that's our Platinum ETF, that's physically backed. COMB or COMB, that's our broad commodity ETFs. That's just a fund that owns 23 underlying commodities. That's futures contracts behind that one.
You there, Will? Did we lose you?
Yep, I'm here. I think you just cut out for a second.
Okay. So I was asking you about platinum. Where does platinum fall in somebody's portfolio?
Yeah, interesting. Platinum is kind of a hybrid in a way between a precious metal like gold. So it has some of the store of value properties as gold does. In other words, it's one of the metals which is used as jewelry as well as used in industry. So it has some things in common with gold. But it's also very much an industrial metal, which is unlike gold in the sense that the majority of the demand for platinum comes from industry as opposed to investment demand or from jewelry. Platinum is used in the production of catalytic converters. And those are the devices that are in your cars and your trucks, etc., that clean the emissions from your internal combustion engine. So platinum is a metal that's used for the catalyst process in the internal combustion engine, particularly for diesel engines, where you tend to see more platinum. But that metal is interesting because it's often compared to palladium, which is its counterpart. And the price of palladium at the moment is almost 3 times that of platinum. And so from a platinum perspective, automakers can substitute platinum for palladium 1-to-1. And so there could be a more immediate opportunity to substitute platinum for palladium and therefore increase the demand of platinum. But it's also, just taking a step back, it's kind of a more interesting story from a more longer term perspective, because platinum for longest of time traded at a premium to gold. In other words, an ounce of platinum was worth more money than an ounce of gold. And that relationship was sort of so ingrained that, in the English language, we think of the word platinum as meaning above gold. So hence a platinum credit card is better than a gold credit card, etc. And that all comes from this historical relationship between platinum and gold. And, for a number of years now, for a long, long period, platinum is actually traded at a discount to gold. And hence today you can see an ounce of platinum is roughly $1,000 an ounce, whereas an ounce of gold is almost $2,000 an ounce. So a lot of people, again, that are familiar with the precious metals world, like these ratios. The platinum gold ratio is something that you should look at. But for those that think that the price of platinum might revert back to its sort of historical mean and or even go back above gold again, it's a potential opportunity for platinum.
And that would have a much more functional use than the gold bars, you'd say?
Yeah, platinum is very much, it's a key, almost all demand of platinum, let's say 80% of platinum demand goes into industry, and you have a residual which is used in jewelry and then investment. But the majority is used in industry. And so really the main use is in the auto industry at the moment, but there's a secondary use which is gaining more popularity, and that's in the production of hydrogen. And again, where platinum is used as a catalyst, but this time what it's used for is the production of hydrogen, and in hydrogen fuel cells and in the production of green hydrogen itself. So it's some interesting new technology which we think will compete with battery-powered electric technology in the future.
Right. I know that catalytic converters have been it's been a hot topic because it's actually something the thieves are after, and it has quite a bit of demand. And it's been a issue where they've had the car companies and people that have run fleets of vans and things have had to put extra protection under their car to protect those catalytic converters. So it's a
now you know why.
Issue. Yeah, right. I know. All right, let's switch gears to HIPs. So we've got a high income ETF. And that's an interesting one because it holds some closed-end funds, which are always an interesting animal. You have some limited partnerships, business development corp. So tell me a little bit about how that's put together.
Yeah, so the idea behind HIPs, again, is that, what we're always trying to do is provide something differentiated that you don't get from other manufacturers or other issuers. So we recognize that everybody needs income, and that the traditional ways of getting that can be tough in this environment, i.e. dividend paying stocks and or bonds. So bonds obviously have been incredibly difficult for people to find yield, especially now in this high inflation, rising interest rate environment. On the equity dividend side, we saw a huge amount of companies cut dividends into the pandemic, an unprecedented level, and many of those haven't recovered since. So what HIPS tries to do is we take a perhaps lesser known area of the market called pass-through security, and the acronym of HIPS stands for High Income Pass-Through Securities. And we try and focus on pass-throughs. Now, pass-throughs, for everybody that are wondering, are simply companies or stocks, securities that don't pay or are not subject to corporation tax. So they're called pass-through because they pass through substantially all of their income by law to their shareholders. So examples of pass-through securities would be things like real estate investment trusts or REITs, business development companies or BDCs, CEFs or closed-end funds, and or MLPs or master limited partnerships. So kind of automatically, you're starting at a higher level of income because they're not subject to corporation tax. And the idea behind HIPS is to create a fund which has a fixed distribution. There's a fixed dollar distribution of 10.75 cents per month per share. And the idea is you generate a fixed income like payoff, which is the distribution, but you have exposure to the pass-through security market, which hopefully will follow that market over time. And so we've paid that 10.75 cents per month every month since inception. And that's something which is pretty unique to the HIPS fund. But really the idea is you start with a universe of pass-through securities. We're trying to sort that universe by yield and then by volatility. So selecting the securities that have the highest yield and lowest volatility, and then creating a diversified portfolio of 60 securities that represent that particular sector and generate that yield for investors. So right now that's around 9% per annum in terms of a yield, which it would make it one of the highest yielding ETFs in the market. And certainly as of this point in time, one of the only places you can get an above inflation yield in this market, which is kind of incredible.
Yeah, that is pretty interesting. The closed-end fund selection that goes in there, do you factor in premium discount or any of that stuff when you're looking at the end?
Yeah, it's a good question. The short answer is we do. And so we look obviously for, once we're selecting closed ends that have not just a high level of income or a high level of yield, but with low volatility, also ones that are trading at a discount as well. Now, I'll just say, obviously, that like everything, Brian, that's gotten harder, over the years as everybody's really looking for yield. And so the discounts that existed in the space certainly are not what they were, but it's certainly something that's still a part of the process.
Okay, so we've seen a lot of volatility in the markets. Most people are focused on the equity markets, and if they're looking at something else, looking at the bond markets. Year to date, let's just get a quick overview of the commodities market.
Yeah, so year to date, the broad commodity index is up 30% roughly versus the market, which has been down, depending on which way you look at it, it's up a little bit, but let's say down 10% roughly. So it's kind of tells its own story. Commodities outperforming stocks quite considerably. And that should come as no surprise, given we're seeing every day on the news, the price of oil is here, price of gas, gasoline at the pumps, price of food, materials, everything has really gone to new highs.
And the outlook for the rest of the year, what are you expecting?
Well, typically what you get with higher inflationary periods is that you get periods which can stay in place for quite some time. Obviously, we saw that last real period of high inflation that we had was in the 70s, which lasted a decade. And so it's typically these inflationary forces are very difficult to control once the so-called genie's out of the bottle. So I expect this to remain in place, prices higher for some time. And really the reason is twofold, that what's happened underneath the commodity markets is as I mentioned before, that we had a peak, back in 2011 for a lot of major commodities. And since then, there was a big sell-off, a bust, a bear market, whatever you want to call it. But it led to, let's say, a decade of woeful underinvestment in the space. In other words, capital expenditure on new production, etc. And then you kind of have this movement that has really come to the forefront the last few years, called ESG. And ESG is an acronym that stands for environmental, social, governance-based investing, which really has sought to restrict capital even further, you may say, to some of these industries, fossil fuel industries in particular, but mining, etc., that don't necessarily conform to these ESG principles. And that has really just exacerbated the situation to the point where now we're looking for new or for more oil production, for example, more oil barrels to come on the market as a country, major or largest commodity producing country in the world, Russia, is effectively being cancelled by Western governments. And that's just not an easy proposition to solve. And so getting new production in terms of starting a new copper mine or putting more steel production in the market, these things take a long time. And so it's going to take a number of years for us to solve this. Now, the only potential way that this can get solved, which is a bad way for everybody, is that if these high prices lead to recession. In other words, if the consumer can no longer pay these higher prices and it ends up in lower demand, and lower demand is what ultimately causes the commodity prices to fall. And remember, commodity markets are simple supply demand driven. Right now, we don't have enough supply and we have too much demand. But that equation can balance out by obviously one of those factors being brought into line.
The inflation that we've had over the last 12 months or so, is that sustainable? Could you see that happening again for the next 12 months, another 7% number?
Yeah, I think so. I mean, in the 70s, put it this way, the last time we had a CPI print of 7.9%, interest rates were 13%. Right now, they're 0.25%. So this is a seismic difference between where we are right now versus where we were in the 70s. And clearly the Federal Reserve, other central banks around the world are in a very difficult position because they have huge amounts of debt out there, trillions and trillions of dollars of debt. And they're in an environment where we've put interest rates to zero and we have the highest inflation for 40 years. So what do? They can increase rates. Of course they can increase rates, but it comes to a point where the market, it's going to be hard to process those interest rates. And certainly the last time the Fed tried to do that, of course, ending up in the peak of that tightening cycle, which started in 2015 and ended in 2018, 2019, we only were able to raise rates, 2-3 percentage points before they had to back off. So it's going to be very hard to raise rates again to anything like the levels that we saw in the 1970s, particularly without avoiding some kind of major stock market crash as a result.
Okay, so for your regular investor, we're not looking for day trades or somebody to make a dramatic shift, but for those looking to tweak their portfolio or maybe make an adjustment for a different type of market that we might experience, what kind of peripheral or tactical changes would you recommend?
I think right now the prudent thing for everybody to have in their portfolio is some way to hedge against the effects of inflation. That really is a force that is really the death of money as we know it and traditional forms of investing. Really that is such a destructive force, inflation. And so some way to protect against that, own some gold, own some commodities as a way to hedge against the ravages of inflation. But I think that's really the one thing right now, if we've learned anything from prior inflationary periods, is that an allocation to real assets, buy physical things. Property is also good. You just don't want exposure to the traditional, or too much exposure, I should say, to traditional things such as stocks, certainly bonds, and arguably the US dollar as well.
How about how about inflation protected securities? I mean, obviously there's a lot of tips funds out there and people look at the name and they think they're protected. Why would those work and why wouldn't those work in what scenarios?
Yeah, so I mean, look, this is the problem, that tips are typically designed or typically work well in periods of benign inflation. In other words, practically non-existent inflation. Look at the performance of tips year to date. They're down. Yes, they recovered a little bit over the last sort of 2 or 3 weeks or so, and that's largely because interest rate expectations went down again, but since have gone back up. And the problem is with tips ultimately are bonds, and bonds have had a very, very difficult time because with interest rates at zero, bond prices are at very elevated levels. And so it comes a point where the price of tips doesn't go up more in these kind of scenarios, and then add in the effect of inflation, it's a negative. So yeah, just look at the performance year to date. It hasn't been pretty versus certainly something like gold.
Mm-hmm. Aside from the war and everything in Ukraine that gives us all an uncomfortable feeling, what is it about the market overall that keeps you up at night, that has you concerned? What is that we're all sort of missing, the general population, that you maybe have some insight on?
I think that leaving aside, like I said, the war and the obvious escalation of that and the effects of that on the market, I think if we're sort of able to look past that for a second, or at least put that risk to one side for a second, I think again the biggest risk is how inflation plays out in this economy, and particularly, can inflation be contained around this level, or does it really start to be destructive and force the central bank into a policy mistake and or recession, really? And it's really just, can we contain inflation? Is it something that even to keep a lid on inflation around about these numbers, although it would be very high and although it's very destructive to a lot of people, I think that's better than seeing higher prints clearly up into the 8%, 9%, and possibly double-digit inflation. So it's very difficult because that's a very fine balancing act that the Fed is trying to manage at the moment. But key to the prospects for this year in the market, outside of the obvious situation of the war in Ukraine, is going to be how the inflation story plays out.
Okay, so you have the 5 products, you have the 5 ETFs. Where are you seeing most of the flow going year to date so far?
Year to date, I think definitely into broad commodities, ComB, and that's where the majority of inflows have been year to date. And that's not surprising, given just the general interest in broad commodities. Gold is something that we kind of always see interest in, hence why you see it's a bigger fund than the rest of them. However, clearly in these times, you get more interest in gold as well. But broad commodities definitely have been the story year to date. It's something that people just can't escape from if you turn on any kind of news source on a daily basis. So that's where the majority of interest has come from.
Okay. And you put out a lot of great research. Your website is GraniteShares.com. So I look at that as a source of not just information about your products and up to date. As some folks may or may not know, all ETFs, their holdings have to be shown on a daily basis. So you can always go in there and see what the holdings are, which is different than a mutual fund that doesn't have to report as frequently. But GraniteShares is also a great resource to keep up to date on the weekly commodity markets, if that's something that you're interested in. As we wrap up here, Will, what about GraniteShares or the commodity markets? Should I have asked you and didn't?
I think we pretty much, covered the majority of the main stories. Probably the one thing that we haven't talked about, in detail, or at least specifically, is the oil price. And again, there's a basic outlook for oil, of which again I think that the oil price stays elevated for some time. There's too many geopolitical issues going on at the moment. The only thing short term that's affected the oil price seemingly on the negative side has been the huge lockdowns, COVID lockdowns that we've seen in China, where they're locking millions and millions of people down, that potentially will have an impact on demand. But otherwise, I see the oil price remaining strong. Again, just like inflation, the key to oil will be, can it be contained around this sort of $100 to $110 a barrel level, or will it go higher and really start to cause some serious damage to the economy? I hope it doesn't, but certainly it's a possibility with what's going on.
Okay. All right. Thanks, Will. I feel like we could go on for a couple hours. I know there's lots we could talk about, but thanks for coming on. We appreciate everything you're doing at GraniteShares and all the research that you're putting out. GraniteShares.com. Will Rhind, the CEO and founder. Thanks, Will.
Thank you so much, Brian.